Prepayment penalties are fees that are charged by a lender. Okay, so typically, you will have to look at your loan documents prior to signing. But prepayment penalties are charged, they're fees charged by a lender if the borrower pays a loan before the agreed upon term. Okay. And we use it in private lending all the time. Private lenders can impose a prepayment penalty to ensure that they are getting the expected interest income over the course of and term of the loan. Okay. The penalties sometimes, they're outlined in the loan agreement. They can be, they can vary depending upon the lender or the terms that you've agreed upon, as a lender with the borrower. Sometimes they are phased out. So basically, there's a period of time, within the first 5 years, there's a prepayment penalty that will apply. After 5 years, it's phased out. It's no longer 5%, it's no longer 3%, and so forth. So it could be structured differently, but it does ensure that the lender receives a certain percentage of interest income. And now, when we say a prepayment penalty, it applies when the borrower pays off the loan before the agreed upon term. So if you've agreed upon a 5-year loan and you pay it off in 3, and there's a prepayment penalty of 5%, you will be charged 5% of the loan. Okay. Private lenders impose that prepayment penalty to protect what they expect as interest income. Okay. They're a financial safeguard basically for lenders against potential loss of anticipated interest income. Lenders, if the loan is paid early, basically lenders lose out on the interest payments they would have received over the full term, okay, or the term for which the penalty applies, right? So the prepayment penalty just compensates the lender for that, okay? The loan agreement terms, they have to be, any prepayment penalty has to be fully disclosed in the loan agreement, okay? It will specify the circumstances for which that prepayment penalty will apply. It will also give the amount or the method of calculating the penalty. It will will state the duration for which the penalty is in effect. Like I said, it doesn't necessarily have to be the full term of the loan, but it is crucial for the borrowers to know and understand when it applies, and to make sure that it is really acceptable to them. Okay. The calculation of the prepayment penalty can vary based on the lender. So, two common methods basically are, a percentage of the outstanding balance. So the lender may charge a percentage of the remaining loan balance as a prepayment penalty. Okay. So for example, if the remaining balance is $100,000 and the prepayment penalty is 3%, the borrower would have to pay a penalty of $3,000. Okay. If they're just going based on the method of an interest differential, the method calculates the prepayment penalty based on the difference between the interest rate on the loan and the prevailing interest rate at the time of the prepayment. Okay. The borrower would need to pay the lender the amount of interest income they would have received if the loan had been paid off at the agreed upon term. Okay, but there's different ways to calculate that, and I would definitely, look into how the loan is structured. But both the borrower and the lender must know how and agree upon how it will be calculated. Okay. Private lenders definitely, have a wide variety of ways to actually, structure this. You might have a fixed prepayment penalty that remains constant. Others may have a sliding scale. Again, there are many traditional lenders that previously in the downturn many years ago in 2008 had sliding scale prepayment penalties. So it's not just private lenders that have that. Traditional lenders also have that. Okay, so it's crucial for borrowers to understand that. In certain cases, borrowers can negotiate, particularly with private lenders. If there is they might negotiate out of a prepayment penalty, or they might, be able to negotiate a sliding scale. It depends. Okay. So, um, it is not a universal practice among private lenders. However, some private lenders may choose to impose them. Okay. There are other ways to, maybe continue the relationship between the borrower and lender. Check out some of our other videos to learn more about how to do that. And commercial loans and in private lending, you may substitute collateral if the lender and the borrower have an ongoing relationship where the lender is lending money. And so, but in this case, we're talking about prepayment penalties. And normally with a prepayment penalty, one piece of collateral or, even a number of pieces of collateral are all within one loan. And you as a borrower and lender must know what you're negotiating and what, if prepayment penalties do apply.